So today we're going to continue talking about cash allocation and management. And if you haven't seen our video on the cash balance tracker, go ahead and check that out. That tutorial is going to handle more of how to map out cash management in your business. Here we're going to talk about cash management and allocation strategy from more of a bird's eye view, more of a strategic perspective. This video is good if you are trying to think about cash and capital allocation at a high level, and maybe you haven't. We're going to talk about a few key principles here. And I'm going to begin by saying that cash management is a critical part of what any business does, whether you're a sole proprietor, a solopreneur, or if you are a Fortune 100 company. Warren Buffett is famous for his cash and capital allocation strategies, namely that he allows the businesses in his portfolio to operate under their own management. He doesn't impact the actual operation and strategic and pricing decisions on his portfolio, but he does require that he can allocate the remaining cash flow. That's how important cash allocation can be. So Warren Buffett is looking at it, and here we are looking at it as well. So to the principle, you simply need cash flow. It is your heartbeat. Even looking at a startup, it may not have cash inflow, but a startup that's trying to scale fast, blitz scaling, as some may call it, will have significant cash outflow with the expectation of future earnings and inflow. Similarly, in your situation, you may not be receiving cash flow now, but you are expecting that the investments you are making will return some level of cash flow. And I'm not going to get into those details here, but as much as possible, using a cash projection or a cash balance tracker is going to allow you to understand at what point your business becomes cash flow positive. So do take a look at that. In certain situations, you may be receiving cash inflow with the expectation of future outflow. So some examples, Airbnb hosts receive deposits for future stays. And if you follow what happened during COVID, many hosts received cancellation where, for the first time ever, they had a constant string of Airbnb debiting that cash back to fund the refunds. So these are situations where you're receiving cash inflow, and now you have an outflow that comes later. And similarly, digital advertisers that we know and we work with receive average client advertising money with the expectation of spending it later, right? So as you can see, there are many nuances when it comes to whether the cash is income, whether it's earned. Those are separate conversations that are important. In some cases, reserves for future expenditures is a critical part of your business. So there are a lot of details to get clear on, but the point is that if you're a small business owner, the decisions you're making now are impacting your net cash flow over time. And as I said in some of these examples, the decisions you're not making can determine your near-term net cash flow. We say you have complete control of your immediate net cash flow, right? You can make decisions right now to generate a sale. And that's going to be the last thing that you do before you leave the office. That's impacting your business right now. And you can certainly cut costs to minimize cash outflows. So you can make decisions today that have an immediate impact on near-term cash flow. Very easy to understand. But we also encourage our clients to think through second and third order consequences, right? And in those situations, we say that you have a strong influence on your near and medium term net cash flow, meaning decisions you make today are also impacting either income that's coming in or expenses that are happening. However, you don't have complete control. It's not the same thing as flicking a switch. It is dependent on market forces. As we've seen, in the past. There are major economic disruptions. We've experienced one in 2020 that completely change any expectation of near-term decision making. But the fact remains, the decisions that you're making now have a long-term impact. And one example I love going to is that Amazon, in its early years, went for broke building out the infrastructure to sell books online. That business made no net income. However, today it is one of the most profitable companies in the world because of Amazon Web Services. So the decisions that built out the infrastructure for its selling of books eventually led to a very profitable business that has very strong cash flows. Now, this took over 20 years in the making. And the point we may want to come away with is that Jeff Bezos and his sergeants at Amazon had a long-term plan. So in the same way, your decisions today determine your immediate cash inflow and create cash outflow, but your strategy determines your long-term net cash flow, which should always be considered. So big point that we want to drive home here is you need to get a sense of what your overall plan is for yourself. That might mean a plan for your family. It might mean a plan for your team. But what kind of business you're stretching out to become should really go beyond the 1 year mark. So anything we talk about here, I want to put an asterisk and say, there's got to be a bigger strategy, which hopefully we can encourage you to think through today. So we've talked about having a strategic view on cash or capital allocation. To do that, we need to understand the different buckets between which you can allocate that capital, right? Ultimately, the decisions you're making are trade-offs. And we typically think through 3 core buckets. And these can be broken out further, but for the time being, we want to create 3 main pillars for capital allocation. First, let's talk about business funding. I'm not going to read this whole thing verbatim, but the point is that you need to understand what your business costs are today and over time. You can think about your business funding that you need to keep the lights on, and the breakdown can be a discussion about whether you actually need the electricity versus the gas. Those might be trade-offs that happen down the line, but you do need to understand situation normal, what your business funding is in a week, in a month, in a year. Those are going to drive how much capital you need. So you may use sales to cover your costs, as most profitable businesses do today. Or you may require, as a startup or as an investor, a significant amount of capital to hold over the investment period or the pre-revenue period. Those are things that are going to be driven by, should be driven by an understanding of what business cost you have. So our first category, call it business funding. We don't necessarily mean it as a source of funding, but this is what you're going to need to fund your business operations. Next, we talk about reinvestment. If you could work on anything, what would that be? That is going to drive what you should invest in. Now, I'll just give you an example. If I ask you the question, if you could make anything happen by waving a magic wand, what will your business look like? Those bells and whistles, a lot of the times, are going to be important and are going to point you at the business you're really trying to create, right? Really trying to create a business surrounded by very smart people who work efficiently and collaborate. Well, I might need to invest in a new collaboration tool, right? I want to create a real estate empire that cash flows positive and operates without me. Well, you need to go invest in a property management company that's going to be able to run that for you, right? Or you might have to invest in software that's going to be able to track your accounting, or you may have to invest in an advisor who's going to help take you to the next level as a CEO or a business owner. These are the buckets that are very important down the road over time. Finally, and last but not least, you need to pay yourself. And look, as someone who started a small business in my late 20s, I had a fruitful career as a consultant, but I had a lot to learn as a business owner. So I paid everyone else, and I personally suffered because sometimes there wasn't anything left. I didn't put myself first. And, I will say there's a book out there called Profit First that gets at this. I'm by no means trying to steal the fire there. I think it's a good consideration to think about. But the point is that part of your allocation strategy should be paying yourself. Otherwise, what's the point? And you might say, well, look, I don't need anything now, but I definitely want to make money over the next 2 years. That's fine. That's still, that means your allocation today is zero. But if I ask you, hey, this business is cash flowing year 2, you're still going to have to answer the question on how much do you need to operate every month? What are you going to reinvest to make your business better? And then what are you going to pay yourself, right? So just because you're not paying yourself today doesn't mean you get off scot-free in this category. You've got to make a return on capital. Otherwise, you may as well have put your money in the stock market. So now that we covered the basics, let's take a look at a cash allocation analysis for a small business that we worked on. And the first thing to get very clear on is what your average cash operating balance is. So we've got 31,000 here. And again, if you watch the cash balance tracker video, you'll understand that there's a way for calculating what your average cash balance is. But let's just say we know, and we have something like 32,000 that we know on average is what sits in the account. And this might change. Again, that's why we use an average. And then we have something we call the business savings or the war chest. Sometimes our additional savings accounts are purposed already, meaning sometimes we have a business account that is going to be dedicated to profit or dedicated to reinvestment. I'm not going to get into that, but just suffice it to say that we have 2 buckets of cash, one that we're not really touching and one that is operating. It's going up and down, but on average we have 32. So now I can think through, and I should look through my books to figure this out. But now I'm going to start thinking through what expenses I have that dictate how I break up my cash into the buckets we described earlier. And in this case, what I've done is I've moved around earnings and profits to pay yourself first, your operating budget second. That was the category we called business funding. And then reinvestment last. And that just makes sense in terms of putting ourselves first. So I begin with, the earning and profit categories. So here we have what we're going to pay ourselves. So in this case, we have someone who's drawing $3,800 a month. So hell or high water, I'm going to take this home. We're okay with that. You can see here that there's other categories to consider. Personal savings, right? I'm saving for a home right now. So actually, maybe I will actually want to pay myself an additional $2,000. Well, it's important to understand that that amount, for all intents and purposes from a business perspective, is you paying yourself. And again, we have a SEP IRA Roth. This is about business, long-term personal income. All of these are going to add up into the category of earnings and profit, right? So end of the day, I'm looking at percentages here as a total of my operating cash flow. In this case, I'm going to have 3,800, that's about 12%, and then about 5,800 on the whole, right? So these are numbers that I'm very keen on understanding, and very keen on understanding of whether I'm doing the right types of allocations. Then we have the operating budget, and this is where things get really interesting, right? I'm breaking these out over variable costs and fixed costs. So we've talked about the COVID example, right? Or massive economic disruptions. The variable costs are is what can come down. And then the fixed costs are oftentimes things that we do not have control over, but in certain situations, we can renegotiate. So important that we break these 2 things out. But overall, right, we're saying that it costs about $12,000 to run the business. I don't have any cost of debt here. Also important to understand, you can't ever stop paying your debts as a business, right? So we consider that, but here in this case, it is zero. But again, $12,000 is our operating budget. As a percentage of all our cash, it's about 25%. Here, you're seeing 40% because this is a percentage of the operating budget. So it gives me a good sense that, okay, look, my overall expenses, when I add up my 40 and 20, 60% of my money here, if I add these two, right, is going to constitute the money that I'm going to take out. So that's a pretty healthy business. And when you factor in the business savings, you're pretty safe. 25% of a operating budget seems to work. Now, one thing I want to highlight is that if the business didn't receive any income, right, and we had 30,000, we paid ourselves once, that money would draw down. Well, then you may only have enough for 2 months of operating budget. And the way to do that is you can override this, right? So if I just wanted to say, okay, hey, I want to multiply this times 2, you can see here that 50% of my cash now would keep my business afloat for 2 months. So that would tell me that my run rate is at least 60 days. That is a good and healthy metric. Now, what about reinvestment? Because we have some amount here, and I think the point is that we never want to stop investing in our business. Obviously, this is sometimes the first thing to go when things get disrupted, but it's important that we maintain that vision of what business 2.0 looks like and that we have some amount dedicated here. 5% is what we have dedicated. It's a very small amount. We typically see anywhere from 10 to 20% in larger companies that are investing in some kind of proprietary technology that they expect to see massive returns on. But this is going to vary. So just a point about overall percentages, these should be benchmarked against your type of industry. So I'll give you one example, a freelancer, and we do these for individuals who do services, is going to have a very high amount into earnings and profits, sometimes up to 60% of all cash. They're just taking it off the table. They're providing a service. And then reinvestment can be very small. Maybe it's a lesson. Maybe it's a professional certification. But it's not going to be a significant driver depending on what stage the freelancer is in their career. And their operating budget's going to be very small, sometimes 10 to 15%, because it's a service business. But contrast that to an e-commerce business, and these numbers are all going to shift around significantly. Earnings and profits will, as something that's paid to you, is usually going to be small for something, say it's a 2-3 million a year e-commerce business. They're going to pay themselves something reasonable. Sometimes whatever's left in the business, call it a 10 to 20% payout, right? Their operating budget is going to be very large because inventory is going to make up a lot of the cash outflow that the business needs. And then reinvestment, usually very small for an e-commerce business because reinvestment outside of inventory is usually just efficiencies. So these percentages can be very different and should be benchmarked and understood. But the point is that you should always set a baseline and get an understanding of where you are in your business. If your earnings to profit ratio is below 5% and you have a lot of money left over, right, residual working capital, consider increasing your salary, right? You have a note here, we always say, love yourself, pay yourself. You've got to increase your income over time in a successful business. Whether that is going to be something you do over a 5-year period versus a 6-month period is completely up to your business strategy. But the point is, costs increase every year. Shouldn't your income? We think so. Back to what we're looking at here, we think it's very important that the different types of reinvestment be evaluated. And we will break these up into either technology costs or investment costs that are going to increase your efficiency, right? Or decrease costs, right? And we often see this be as the learning curve. So you go down the learning curve over time. Part of this is natural learning, but there are also investments you can make, getting a consultant, hiring a board member who has done this type of business before. These are all going to give you benefits over time that are going to decrease your costs, increase your margin. So these are cost decreasing investments, and the opposite happens in terms of efficiency. Your efficiency grows. And then you have sales increasing investments. These are growth related investments. This is what PayPal was doing when they were paying referral fees for you to bring somebody on. And then you'll see down here profit protection. These are things that are going to insulate your business, right? These can be differentiators. In certain businesses, it is legal spend to make sure that competitors are not copying technology. But the point is, there's different ways to break down how you reinvest in your business. And all of these are going to be important, however, are going to be different depending on number one, your industry, and number two, your strategy. So with that, we want to go back to our summary and say it's all about cash flow. A business that doesn't have cash to flow is no longer a business. When cash falls, so when major disruptions happen, you need to reallocate capital. But we encourage all our clients, anyone listening to this, to take a hard look at reinvestment in yourself. Because if your business is one that can survive, then perhaps a short-term capital allocation is necessary, but have a plan to bring reinvestment back and bring back your own payments. Because as we know from history, businesses that can maintain cash flow and reinvestment are the ones that win over time. It's been a pleasure walking through how we think through cash allocation and management. We hope this adds value to what you do. If you've taken 1 to 2 takeaways from listening, I hope you write them down and act on them soon. If this has added value to what you do, please like and subscribe. If you have questions, leave them in the comments. We look forward to talking with you. Thank you.